Welcome back, everyone. Today, we've got an absolutely packed explainer lined up for you. We are doing a full masterclass review on the ultimate portfolio strategy. If you've been following along, we've covered a ton of macro theory. But today is where the rubber finally meets the road. We are building that ultimate bridge between high-level economic theory and personalized ground-level execution. So grab your notebooks, because this is literally going to change how you look at your wealth.
Right off the bat, I want to bust probably the most expensive beginner myth out there. Wait for the economy to recover, and you lose. I hear this all the time from new investors. They want to wait for the official economic recovery data before putting their money to work. But honestly, if you wait for GDP to grow, unemployment to fall, and consumer confidence to return, you are going to miss the market's biggest and fastest gains. By the time it's officially a recovery, the market is already up 30, 40, maybe even 50%.
Okay. Let's dive into this. Here is our roadmap for today's masterclass review. Number 1, the market locomotive. Number 2, 3 buckets of wealth. Number 3, true 3D diversification. Number 4, your next investing steps. And finally, number 5, the diversification challenge.
All right, moving right into section 1, the market locomotive, market versus economy.
We really need to clearly define the actual relationship between the stock market and the broader economy, because they are definitely not the same thing. The metaphor here is just fascinating. Think of the economy as a train, right? The stock market is the lead locomotive. It acts like a crystal ball that looks into the future and pulls everything forward. Trailing behind it are the lagging carriages, stuff like GDP growth, employment data, consumer spending numbers. The locomotive always moves first. By the time those data-heavy carriages actually catch up to where the locomotive went, well, the market is already miles down the track.
So the crucial point here is this specific timeline. 6 to 12. The stock market leads the economy by 6 to 12 months. This is an undeniable historical fact. Just look at March 2009. The stock market bottomed out and surged 30% before the recession officially ended 3 months later. Or look at March 2020. The market bottomed out and was up 40% by June, while the economy was still in a deep contraction. The market always looks ahead.
Let's transition over to section 2, the 3 buckets of wealth in your overall wealth structure.
Now that we know how the market moves, we have to shift our focus to how your wealth should be actively structured to survive and thrive in any of these market cycles. And this brilliantly illustrates the mental framework you need. Imagine categorizing every single invested dollar into one of these 3 slices. We've got the cash bucket for opportunity, the passive income bucket for cash flow, and the capital gains bucket for growth. Literally, every single dollar has a specific job.
Let's look at the target rules for each of these. You want about 20 to 30% in your cash bucket. And listen closely here. Cash is not idle money. It is a loaded weapon just waiting for periods of low market optimism. It's your opportunity fund. Next up, your passive income bucket should target a 5 to 10% yield. You get this through REITs, dividend stocks, or bonds, basically getting paid while you wait. And finally, your capital gains bucket. This is your growth engine, targeting a 10 to 20% or higher compound annual growth rate.
Let's move along to section 3, true 3D diversification, beyond random stocks.
We really need to clarify a very dangerous misconception right now. Just owning 20 random tech stocks absolutely does not mean you're diversified. Let's see how true diversification builds your ultimate financial armor. There are 3 distinct dimensions to this. First, asset classes. This means spreading your money across stocks, bonds, cash, and commodities. Second, sectors. Mixing tech, healthcare, real estate, and finance. And third, countries, blending U.S. markets with emerging markets and other global powerhouses. Taking this true 3D approach protects you against isolated political risks, sudden currency swings, and devastating sector crashes.
Now, I really want to warn you about the trap you see right here, the home bias trap. Look, it's just human nature to invest only in the country where you live, right? Because it feels familiar, it feels safe. But you've got to fight that urge. Absolutely no single country dominates the global economy forever. If your entire portfolio is tied to one nation's economy and currency, you're exposing yourself to massive, unnecessary risk. In reality, your portfolio should have no borders.
Which brings us to section 4, next investing steps, pulling it all together.
That brings this 4th part of our explainer series to a close. So let's recap our 3 key lessons before we look at what's next. Number 1, the stock market leads the economy by 6 to 12 months. Buy before the economy recovers, not after.
Number 2, true diversification means asset classes, sectors, and countries, not just different stocks. And number 3, use the 3-bucket framework: cash for opportunity, passive income for cash flow, capital gains for growth. In the final part of our series, The Next Explainer, we pull everything together. I'll show you exactly how to build your own personalized investing strategy using the 3/3 portfolio, the 50/50 risk management method, and
The complete 5W1H decision framework. This is the ultimate checklist that you'll use before every single trade for the rest of your investing life. This is the one holy grail tool that ties the entire course together. It asks what, where, which price, when, why, and how much to buy or sell. You definitely won't want to miss that massive unlock in our next explainer.
And finally, Section 5, the challenge: audit your wealth.
Before we go, I want to break the fourth wall here and speak directly to you for a second. We're going to do a quick, interactive audit of your current wealth right now. Quick challenge: what is your diversification score? I want you to literally write down where your money is invested right now. Is it all sitting in one asset class, one country, one sector? Calculate your diversification score and drop it in the comments below. Seriously, be honest with yourself about where your exposure actually lies.
Hit that like button if this changed how you think about diversification. And make sure you subscribe so you don't miss our final explainer, because it is the most actionable one in the entire series. Click the card on screen right now to watch it. Also, check out the pinned comment. How many countries, asset classes, and sectors are you actually invested in? Be honest. If you discover you've been putting all your eggs in one basket, our final explainer will show you exactly how to fix it. I'll leave you with this final thought. If the market crashed 20% tomorrow, would your wealth collapse like a house of cards or stand firm as an armored fortress? Keep investing wisely, and I'll see you next time.